what I want to do is touch on on a case study. I think it's probably easier to demonstrate how it's actually looked at from a bank's point of view by going through a practical example. So we're going to look at a commercial property, and to be honest, most of the loan facilities that we do in this space are commercial properties. And the purchase price is $1 million. Property custodian set up, and as I mentioned before, it's a corporate trustee, it's a bare trust, and it fits in terms with the client's investment strategy. From a banking point of view, we don't determine whether it's a relevant strategy or anything like that. That's what the accountants and financial advisors are there for. But we do ask for a sign-off by their financial advisors to say that it is in compliance with their strategies. So how do we actually look at funding the transaction? In terms of security, we take a first registered limited recourse mortgage over the commercial property given by the custodian. What that means is that the actual mortgage is in the property custodian's name, and that we take a limited guarantee from that. And the reason we take the limited guarantee is because we can't take the mortgage without having a linking document, because the loan is going to be in the self-managed super fund's name. And that guarantee is limited to the facility. One of the key things that we've had to be careful about is to make sure that we don't have any access to any of the other assets in the super fund, and that's why that's expressly limited, to make sure that it's only covering the mortgage of the property being offered as security. So if we look at 58% or 58.5% in terms of maximum loan amount against a property of $1 million, we can lend $580,000. So the funds required to be provided by the client is $420,000 plus costs. So the other half of the equation from the banking side is around the income and the servicing of the loan. And for this property, a real estate agent has advised that there's a lease in place of $80,000 per annum. After equity required for the purchase, so we talked about the client needing to put in $420,000 and costs for this purchase, there's another $200,000 which will be assets in the fund that are earning an income, and they're earning 3%. And members' contributions for the past 3 years have been $50,000. Just on that point, if it's a brand new fund, we will still consider members' contributions if it can be proven that they could have made those contributions over the past 3 years. So being a brand new fund doesn't preclude the fact that they may need to make contributions in the future. So if we look at the pure maths of it, we take 80% of the rental income, so that's $64,000. Investment income, we take 100% of that, so at the 3% it's $6,000, and then the contributions we take 80%. So you're looking at a total income of $110,000. In terms of interest, you're looking at an interest rate of around the 7%, so you're looking at about $40,000 worth of interest fees across the year, and that has an interest coverage of 2.71 times. And from a bank's point of view, we're actually looking for a minimum of 1.5. So that's one that's purely compliant, and it's pretty straightforward. I suppose in terms of some of the key messages that we've seen, we've done a number of these transactions since the legislation changed. To be honest, at the very beginning it was pretty quiet. There was a lot of people who were trying to find out information about who's doing what, can we do this, can we do that, and there was a lot of inquiry but not many deals. Then we found that as time went on, people started to get a little bit more comfortable. Then there was a change in government, then the budget came. So of recent times, we've had a huge increase in uptake in this, because people are getting a little bit more comfort around the fact that it's not just going to be pulled. What we have noticed across everybody, though, is that no one's pushing boundaries, given that it is brand new and given that it's it hasn't been tested through the courts, it hasn't been tested through the ATO. People have really tried to fit between, within the box and not push those boundaries, and they're being prudent. So, whilst in a normal lending transaction, an LVR of 58% might be considered pretty conservative, people have generally been quite happy to look at that LVR so that they're not, pushing the envelope at all. In terms of considering future needs and flexibility, that's pretty important. A lot of the inquiries that we've had, people have said, I own a commercial property, it's business real property, I want to move that to my super fund. And then when we talk about, well, what do you want to do with that property? They said, oh, we'll look to pay it back, but we might have an overdraft that we have for our business that secures that property secures that overdraft. You can't have structures like that. We can only fund for the acquisition, and we can't charge any assets in the super fund going forward. So we can't then use that property to secure an overdraft if that's what they want to do in the future. So there have been a few cases where people have thought that this was the way that they wanted to go, and then they've actually changed their mind as they've thought a little bit more about what they want to do. And talk to your lender early. Credit conditions have changed over the last 12 to 18 months, and things do take longer. These are relatively new, and they do take a little bit of time to get set up, and there's quite often things that come into play at the last minute that people don't know about. So if I had one word of advice from the banking point of view, it'd be engage your lender early, because then you've got plenty of time to make sure that any issues that arise can be dealt with. Are there any questions in terms of the banking side at the moment?
Would the bank want to see the financials of the fund on an ongoing basis?
No. What we do is in the initial assessment, we'll look at the last 3 years, and then it's just an ordinary loan where, as long as all your commitments are made, it runs. What we do, if it falls in a corporate banking environment, which is the environment that I'm in, an annual review is done each year, and then they may ask for the financials. But typically, it's not where. It's more as an annual review, not to reassess the loan each time. If you're looking at a retail type of product, which is almost like a quasi-home loan, then, as long as commitments